Assalamu alaikum. Welcome to one and all to the Minara presentation. Thank you to Bilal. Bilal Adam is a technopreneur, chairman of Aral Technologies, a blockchain fintech business. Bilal leads innovative fintech empowered investment as CEO of Stewards Investment Capital on behalf of institutional and high net worth individual clients. His previous experience encompasses valuable knowledge gained as chartered accountant with experience at Deloitte and Investec before being offered the role as CEO by Afro-Asia Capital Management. Bilal was nominated as the president of South African Chamber of Commerce in Mauritius in 2020 after contributing to the board for many preceding years. I think we have a very capable person in our midst who, in my opinion, is probably one of the best people to talk to us about crypto and technology and fintech and the banking industry. We've had quite a bit of volatility in the banking industry this last few days. And hopefully Bilal will cover a bit of that in his presentation. Bilal, thank you for joining us. Can I hand over to you?
Jazakallah. Assalamu alaikum wa rahmatullahi wa barakatuh. Auzu billahi minash shaitanir rajim. Bismillahir rahmanir rahim. Zain, Jazakallah for that wonderful intro. Lots of new words we're making up these days, technopreneur, and you got to try and be interesting. But thank you for the opportunity to share a bit about how we see markets at the moment. I think, Zain, we set this topic a few weeks ago, months ago, in fact, trying to pick the right date. And alhamdulillah, what a perfect day to be talking about volatility. It's one of the most volatile days in the market that we've seen, I would say, at least this year. And I would say, volatility, the VIX index moved up from around 17 to 27 over the weekend. It's very interesting. My team, basically, we've been on war mode Friday, Saturday, Sunday, going into today with the amount of volatility we've seen in the market. It's quite a big risk that we're facing at the moment, and we'll cover a bit of that. My presentation wasn't set up for all of that, but I'll try and weave it in as we talk as to things happening live, as I'm actually watching TV while talking to you and watching the markets here. But so let's talk about navigating volatility. Talking to you from Stewards Investment Capital. We're based in Mauritius. So the macroeconomic backdrop. Zain, just give me time warnings as we go.
Sorry, Bilal, just one thing. So to the audience, if anyone's got any questions, we can save it to the end, or please put it in the chat box and Bilal will address it towards the end of his presentation. Thank you.
Cool. Yeah, so we can do a nice question and answer session at the end. So let's start with just clarifying our context. Let's do a stock take and understand where we are in the market. So we all know COVID-19 has impacted our business. I don't need to tell you too much about that, but you understand production of many industries stopped. Many businesses, unfortunately, went bankrupt. People lost their job. Some people passed away, unfortunately. And this led to unprecedented monetary easing. What happened was we saw central banks printing money to push up the stock markets and hold up risk assets. And all of that's actually what's led to the inflation that I want to talk about later on. Even though we had COVID, we saw the stock market lock in the biggest 2-year gain in 20 years. So Wall Street was functioning without reality. Then you put your camera off now, I can't see you. Let me see it. At least I'm talking to myself. So come back. Let's see now. Okay. Cool. So it was the biggest gain in 20 years. Even though Main Street was, or reality was suffering, the stock market was doing very, very well. We saw major supply chain disruption. that supply chain disruption led to supply chain costs going up. Shipping costs went up by 500%. Many people will know this if they're importers or exporters. And the shipping companies had windfall profits for a short period of time. Inventories dwindled because things were not being produced. It's led to massive supply shortages. The biggest, one of the biggest supply chain shortages is in the microchips and semiconductor industry. And those microchips we see are in everything, in your appliances at home, in your cars, TVs, in your missiles that are going to be fired to end up in another world war. So this semiconductor microchip shortage is the glue underpinning a lot of industry at the moment. We all know also that we're facing the Russia-Ukraine conflict. There are many different views on, what caused the conflict, when it started, what actually led to this, and, where it's actually going. But the reality is we are in a conflict. It looks like that conflict has had its anniversary or 1 year of being in conflict. And I read a statistic that said if a conflict lasts 1 year, it usually lasts at least 10 thereafter. So the impacts of this are quite large, especially on, for example, food. The wheat that the world eats, 20% and 10% come from Russia and Ukraine. Russia, as you know, is obviously one of the biggest natural gas and second largest oil exporter in the world. And there are sanctions on Russia and Ukraine, which has disrupted supply chains and supply of crucial things to the world, again, pushing up prices. And then the third reason why prices are going up is inflation. So all of these things that I've mentioned so far are pushing up, the cost of living for the man in the street. When we just look at inflation, there's something interesting to just take into account here, is something called the Cantillon effect. And what the Cantillon effect is, for example, let's say the Federal Reserve decides, well, this is what actually happened. So let's say the Federal Reserve decides, well, there's COVID and we now need a stimulus, so we need to print more dollars and hand those dollars out. Now, if Zain is my friend, and I'm talking Zain Incorporated is a large corporate US entity, and what I'm doing now is I'm handing out the stimulus checks. If Zain gets a stimulus check first, the prices of everything are still the same, and Zain's money in his hand is actually money that is worth more, right? Because Zain's got new money and the prices of everything are the same. When Zain now takes his money and he buys stocks and he goes on holiday and he buys cars and everything, he starts pushing up the price of all the goods. So later on, when let's call it Muhammad, 1 or 2 years later, is getting a 10% increase in his salary, he's getting an increase after the prices of everything has all gone up, and he then is just getting an increase which keeps him at the same place or below, if that increase is below the actual cost of inflation of all of those products. So the Cantillon effect is just about who gets the stimulus first when monetary easing occurs. And there's a lot of talk about inflation and this being caused by Russia and the war, and I pointed that out. It is one of the factors. It's also supply chain, it's also COVID. But the biggest reason is because all the reserve banks printed more money. If you print more money, it's obvious that the prices of everything have to go up. If you have a fixed amount of goods in supply, and you print more money to buy the same amount of goods. So that's really where the problem started. And I think there's a bit of a misdirection where everything is now being blamed on Russia. Yes, Russia and Ukraine is hard to blame, but the real cause of inflation, it was obvious when we printed more money, or all the Federal Reserves or reserve banks were printing more money. Inflation was inevitable at that point. And now we're just starting to see that actually play out. Okay, so just looking at all of this, we try to guess where we are in the market, right? They say history doesn't repeat, but it rhymes. Right? You need to find a time in recent history that has the most similarity to the current conditions, and then try to understand from that position how best to navigate, the short-term future and long-term future ahead. So in our analysis, we think we look a lot like the 2007 financial crisis. And we made these slides about 2 weeks ago. We just added a few new slides now. So what's happening today, which we'll get to just now, is a bit of a banking crisis brewing in the US, which is very similar to the 2007, 2009 financial crisis, when we had the global financial crisis. So we think we are in for a period of heightened volatility, which is already evident today. And what that will do is, it presents massive risk, but it also presents, opportunities. So we just need to understand where the risks are, balance and mitigate them as much as possible, and then ensure that we are positioned best to benefit from the opportunities that come ahead. So right now, I know, we obviously, cognizant of riba interest being haram, but we need to understand also that the US Federal Reserve controls world markets and influences those greatly through its interest rate decisions. So what's quite important here is I'm showing you 3 graphs, which are the global stocks index, US interest rates, and US inflation. And the middle graph will show you the US interest rates, which is how the Fed feeds and constrains the market through monetary policy. And it looks like we are hitting 4.755%, close to peak interest rates that we saw pre-2007 financial crisis, which means, and I mean, what we're saying is, if the Fed increases interest rates too much more, they are going to cause problems in the market. And that's actually what's happening in the banking crisis at the moment, or potential banking crisis, where interest rates have already increased to a rate that many of the US banks, their treasury positions where they hold bonds are being, the bonds are losing market value to a point where if there is a run on that bank, there aren't sufficient assets liquid enough to pay the depositors back, which is what's been happening over the weekend. So with that in mind, I mean, we're looking at inflation. Then we've got 2 arrows here, because we don't believe inflation. We believe that our base case scenario is that this global stock index should go down. The interest rates can't go up for much longer. They eventually need to start going down. But with inflation, we've got arrows both ways, because we don't actually know if inflation has actually been tamed, and which way this is actually going to play out from here on. So we've got 2 scenarios for investments from a stock market perspective. You've got the soft landing and the hard landing, right? The soft landing is where inflation is actually subdued, and then interest rates, US interest rates can be controlled, and inflation comes down, and the Federal Reserve starts cutting interest rates, which means risk on. Everyone feels more comfortable. People start hiring again. It's good. It's good for jobs. It's good for asset values, and we see market, confidence return, and we go back into a rally situation. Doesn't mean, I don't mean we make a U-turn tomorrow. What I mean is it's a curved bottom, and we're closer to the bottoming of that price. The second option is a hard landing, right? In a hard landing situation, inflation doesn't subside, and we actually could see a very, very sharp suffering coming to the economy, more job losses, a proper economic contraction, and a very, very scary situation. I mean, there are sufficient reasons for there to be a recession or correction to the market, which would be the addition, the aggregation of the global financial crisis, the Asian financial crisis, and a war crisis all happening at the same time. So we could, what I'm trying to get at is the risk of a hard landing is real, and it will be very severe if it does happen. So this is a new slide we added in today, is this is today's news. What's happened over the weekend, last week, was we had the closure of Silvergate Bank in the US. Silvergate Bank is a large listed bank in the US, not a top tier bank, but a sizable listed bank. And then we had also the collapse of Silicon Valley Bank, and that has led to some contagion in the potential contagion in the tech sector, because Silicon Valley Bank was the go-to bank of techs and startups and many big innovative Silicon Valley companies. And since then, we've also seen, or concurrent with all of this, we've seen the collapse of, or the depeg of Circle. Circle was the USDC, or is the USDC stablecoin, which was known to be the most secure cryptocurrency. It depegged on Friday and Saturday. It was at 90 cents to the dollar. This morning, it came back to 99 cents. And this was caused because Circle had a significant deposit balance of about $3 billion at Silvergate Bank, which was put into question when Silvergate Bank went bankrupt. This morning, Signature Bank in the US they say it's closed by the regulators. It's still open for transfers. We've been able to do transfers to them, but the regulators, in order to try and ensure stability in the US, have taken control of Signature Bank. So the reality is that there is a major risk and concern, especially for the smaller banks in the US. And what happens in the US is a lead indicator for the rest of the world. So when we look at the US, we don't look at it as a faraway land that has nothing to do with us. Whatever happens in the US, that is really the warning signals or opportunity signals that then follow in other parts of the world. So I would not be surprised now that we have seen smaller, second tier US banks. And when I say smaller, I'm talking about billions of dollars of US listed banks, which are bigger than many of our South African banks. And they are falling over already. So the reality is we are in a world where counterparty risk is important, infrastructure risk is important, and we have to be very cognizant of things changing very, very quickly. So that's all on the risk side, just to put a bit of a good spin on things, because there's a lot of bad news out there. You would have also seen some interesting things with the ChatGPT, Midjourney bot, a lot of news on AI. I think Microsoft invested about $10 billion into ChatGPT, $10 billion. And there's a lot of new tech coming out. And what that tech is doing is it is moving out the productivity frontier. So there's a lot of people that are saying, AI is going to replace jobs. AI is going to, take over the world. And, you're thinking of Terminator and that, Skynet and these robots coming to kill everybody. So maybe, I don't know, maybe it's going to happen. I don't know. Right? But on the basic terms, when somebody invented the camera, before that, somebody had to sit. You had to sit there. Zayn had to sit with a beautiful smile for about 5 hours, and somebody had to paint a portrait picture of his face. Nowadays, you just take a photo of him and you only have to look at his face for 1 second when you take the photo, and then after that you can upload it on his Facebook profile picture. It's always there, right? Now that's technology, and the painters must have been quite nervous when they invented the camera, but it's innovation, right? When the first grader was built and it dug a big hole, the 50 people that were digging with spades must have realized their jobs are going to be changed, and you have to upskill and adapt to new technology. So what ChatGPT and Midjourney bot can do is ChatGPT, it has the ability to answer a question and summarize information that is available freely on the internet. then formulate that into a usable format for you. So I know of restaurants that are using Chat GPT to build their menus. They inform Chat GPT, I'm an Italian restaurant. These are the ingredients I have available. I want to make a few pastas, I want to make a few salads, whatever it may be. And Chat GPT can actually spit out a menu, and you can tweak that. Chat GPT can write letters for you. I tried to write my wife a Valentine's poem, but unfortunately, I think everybody had the same idea, and the thing crashed on Valentine's Day, so it didn't work. But we managed to write a poem another day as a joke for a friend, and you can put the person's name into it. You can tell ChatGPT information about that person, and it can make a very, very relevant and funny and interesting poem. So it has a lot of fun and business uses. And I think ChatGPT will be something that pushes us to productivity frontier and gives humans the ability to achieve more faster. And we will see that come through in productivity in the decades to come. But we're not there now. Now we are in the volatility period for the next year or so. So from a Stewards investment capital perspective, we have some investment products that can manage these risks. I'm not going to tell you about our products. I'm going to just give you the themes and ideas, and if you find them interesting, we can talk about it at a later stage. But to give you some idea and give you some hope of it does look very gloomy out there. It does look like you probably lose money most directions that you go. If you sit in cash, you got inflation eating your real value of money. So if inflation is running at I'm not going to do cumulative annual growth rate, but just some simple maths. If inflation is running at 5%, for 5 years, if you say, when somebody tells me inflation is at 5%, we just think of it as, oh, it's only 5%. Right, or some people actually do concern about it, right? But if you look at 5% over 5 years, there's 25%. So something went up in cost by a quarter. When you factor in the CAGR, the cumulative annual growth rate, it can be in excess of 50%, depending in whichever country you live in and what the inflation rate is relevant to you. So I live in Mauritius, and many products, simple grocery products, have actually already doubled in price here on the island, because we have inflation, plus we buy our goods in dollars or euros, and the rupee has also devalued against the hard currency. In South Africa, we're fortunate because a lot of goods are made locally, so you don't suffer as much all the time from a rand depreciation, but you will see the effect of that inflation coming through. So to give you a bit of a glimmer of hope and some ideas around how to navigate this market, the period of quantitative easing that we have been in since the 2007 financial crisis, where interest rates were very low, what that meant is that if you could borrow money from the Federal Reserve at a very low rate, let's say 1%, then big private equity and asset managers were borrowing money at 1%. If they can make 2%, then it makes sense for them to borrow that money, because they're benefiting, right? Because they borrow for 1 and they're making 2. Now, when the US interest rates have gone up, you actually need to generate a much higher return in order to beat the cost of that cash. Now, again, I'm not advocating for riba interest or anything like that. I'm just explaining that this is how it works, and you need to understand how it works to navigate for yourself, how best to invest and avoid inflation, inflation eating your money, or interest eating through your money. So the first theme that we like is luxury. So why do we like luxury? Luxury is a price-setting industry. People who buy luxury goods, they are not price sensitive to inflation and price changes. They see luxury as a status symbol, and it's proven historically over time that during times of recession, you still have high net worth individuals becoming wealthier because of the Cantillon effect that I explained earlier. And you see that luxury goods actually perform less bad than other sectors, or sometimes even make money, in volatile times. So one of the themes you could look at is investing in luxury brands, listed luxury brands, and this could play out well in a hard or soft landing. This is an example of how luxury has performed since May 2017. And what I've given you here is just a few examples of luxury companies that we have in the Liam Tech luxury index. And you'll see the Aston Martin. I know Zane likes his Astons. The Burberry bags. You got Ferrari. You got Hermès, Hilton, Hyatt. Swatch Group, watches of Switzerland. So many luxury goods that people invest in, and that people buy who are not as sensitive to price increases. So in our investment space, with the current risk that we see, we are not buying equities. What we do is we're buying options. When we buy options, what that means is it gives us the upside participation without the downside risk. What would then happen is, for example, on a luxury index, the options that we're currently doing for our clients, we can get 150% participation in the upside performance of the luxury index. And what that means is if the luxury index does 100%, our clients will get 150% return. And there are some caps and things and how we put that together, but this is just to give you an idea of potential theme you could look at if you're looking to invest over a 5 to 7 year period. Okay, this is a very easy theme. I'm actually 99% sure, if you get the right entry point, that again, sorry, I'm not giving anybody financial advice. This is purely just an informative discussion, just to share a few ideas. But listen, I think this defense theme is quite an obvious one, and it's been doing well for us ever since this Russia-Ukraine crisis. There's been some good investments in defense stocks which have done quite well. So, what is the defense thesis? We've got a picture here of conflict around the world. You can see that there's, you hear a bit about this and that conflict, but there's actually lots of conflict around the world. And there's conflict on almost every continent. Some are minor skirmishes, some are wars, some are major wars. The risk of international conflict is probably the highest it has been in my entire lifetime. There are many things which are happening. Everybody knows about the Russia-Ukraine war. There's also concerns about China and Taiwan. We're all aware of the Israeli-Palestinian issues. I saw today on TV that the Saudis and the Iranians have actually intend to have a more diplomatic relationship, which has been brokered by the Chinese. That kind of a friendship would make Israel feel very unstable as well. And all of these instabilities, and add to that economic instability caused by the inflation, because what happens when you have inflation is, as I mentioned, the US increased interest rates. When the US does that, what happens is all the other sort of second-tier economies of the world, we'll call it South Africa, Mauritius, our reserve banks don't have a choice, right? If they don't increase interest rates, the currencies will devalue too much. So they actually force into a position where they have to increase interest rates, and also a lot of them suffer with inflation thereafter because they had quantitative easing. So the local governments are then blamed for the inflation that is caused in any particular country, but they never actually had the power to control that inflation in the first place. And all of this leads to more political instability, more, social unrest, potential, government coups, and people being thrown out, or change in political dynamics. And all of this conflict leads to a need for more arms. And we see that NATO, the NATO allies in Europe and Canada, have increased their defense spending by $350 billion in 2022. Right. And when we say defense, I'll talk you through what, those stocks and, what that theme actually means. But now, whether or not we go to war, I don't know what the probability of that is, right? But what I can tell you is if NATO is increasing its spending on defense or arms, then every other, country concerned starts to increase their spending on defense as well. So if me and Zain are not trusting each other, and Zain buys, Zain's got a 9mm, and I got a 9mm, then I'm okay. But if Zain now gets a Uzi, then I'm going to be a bit concerned. So I'll maybe have to buy a Uzi also, just in case. I don't want to shoot though, but I'm just saying, if push has to come to shove, I don't want to be sitting there with a CZ83, and he's got his pump action for me. So in the global world, it's the same situation, because armies are what are controlling economies, right? To a large extent. So we're very likely to see an increase in the amount of defense spending. So it's just very interesting to see this. And I know some people out there are conspiracy theorists, but and I'm not going to make a conclusion on this. But if ever you wanted to make money out of this theme, just look how that COVID shock pushed down the prices of defense. And if you knew that you were going to cause a war very shortly after that, it would have been the best time to go and buy all these defense stocks. And I bet you, if they properly audited, many of the politicians and their trusts hidden in all over the world, you would probably find some very interesting defense trades that happened at the end of COVID, ahead of all the potential conflict we see coming up here. Unfortunately, we're not in the know at that level, but we catch the last information as we see wars developing, and we see conflict and policy news happening. So we can also still get on the train, but we get on the train a bit after the people causing the actual issues. So just on the tip, on the defense theme, defense is not just guns and bullets, right? Defense is information, it's satellites, it's semiconductors, it's aerospace, it's metals, it's a much wider theme than what people actually realize. And there are many things that are dual purpose. I was talking about semiconductors at the beginning. You need semiconductors, microchips on many of the defense tools that we have today. So, some of the names you might be familiar with there, Airbus, Boeing, the engine manufacturers are going to jets, Lockheed Martin Group, Raytheon, Rolls-Royce. You think it's a car manufacturer, it is. It also makes engines for many jets and planes. So it's quite a wide theme. The hard part is picking the right company that will actually get the government contracts and that will actually benefit from the theme. It's hard to do that. So what we do is we invest in the index overall, and we get an exposure to the sector generally, which has done quite well for us. The products that we have that invest in aerospace and defense ETF, we do it with options as well, so we're not participating in the downside. Upside participation, you've got 100% plus extra 30% if the portfolio does well. We as I said before, we're looking at this as a period similar to the 2007-2009 financial crisis. In the picture here, you can see a green line and a red line. The green line is a soft landing. The red line is it's a hard landing. What we're saying is we're on the way down. We don't know how close we are to the bottom. We could be halfway, we could be 3/4 way, but we're probably going down in the next few months. And then after that, we see either a sharp reversal or a more balanced reversal. and then we see markets recover. And you can't catch a falling knife. You don't know exactly when markets are going to reach their bottom, and you also don't want to be out the market, because when you're sitting in cash, inflation, you definitely lose because inflation is eating your money. So our risk managed approach to this is that we take 5 to 6 year options on themes that we like. In this particular theme, over a 5-year period, if you had invested in this index in 2009, you would have made 173% over the recovery period. And we think a similar bounce and the shock, the downturn is Christmas, it's Black Friday, it's the best time to be getting to market. That when the world is crying, that's the day you want to be buying stocks. And that's the day when the sentiment is lowest, and the turning point. In the global financial crisis, people, many people picked up quality stocks at really discount prices, and that opportunity may present itself again. We don't know exactly when that's going to happen, but for now, if you use an option strategy, you don't participate in the downside if you get it wrong. You only participate in the upside. The third theme is low volatility. Low volatility just talks about the Zain, how am I doing for time? 21:40.
Yeah, I think how much more do you have to go through, Bilal?
Okay, I got to let me speed it up. I think I got 2 more themes there. So this is low volatility.
Okay.
This one is just looking at equities that have a very tight volatility range, less than 9%. So what we're saying is these stocks in a shock position situation would perform less bad than others, and therefore you participate in recovery, but you don't have the shock to the downside. So in this particular theme, we have an option strategy where you can get 180% participation in the upside of low volatility stocks. And then the theme that we are very passionate about as well, Stewards, we've focused ourselves on digital assets for the last few years, built a number of successful digital asset products. And we've got a strong and deep team that analyzes, so we can share good intel about cryptocurrency. The thesis for cryptocurrency is transparency, security, decentralization. Cryptocurrencies are high beta tech. What that means is whatever beta means, like the amplifier, right? So whatever the general market is doing, if it's high beta, if the general market moves 1% down, digital assets will move 2 or 3% down. So it's a much more volatile asset than your general market, which means that it's going to perform, could have a shock drawdown if the general markets go down, and then we'll have an amplified return to the upside when markets start recovering. And what that means is there could be a very interesting entry point into this theme, which will outperform the other themes in the 5 to 6 year period. But again, digital assets are very high risk. This is for 1, 2, 3, 5, 10% of your portfolio. You don't want to be putting more than that in more than 10% into your portfolio, unless you know exactly what you're doing and you can afford to live with the risk of digital assets, because they are a very high risk investment. So whilst we see cryptocurrencies and digital assets going down, this is a bit about Ethereum. Real usage is still increasing. So transaction count is still going up. The amount of gas fees used is still going up. Ethereum users are going up. Ethereum smart contract creation is also going up. All right. And cryptocurrency is very much driven by sentiment. And we just got a bit of a table here explaining that. I think we're now getting to the fear, desperation, panic stage of crypto, which is when people are going to start panic selling a lot of their assets as we see this shock starting to land. Bitcoin already is 85% of its all-time highs, and it's being pushed by macro factors as much as crypto factors themselves. Now, why do we really like this theme? Is because we think that the upside is worth the downside for the right-sized amount of investment. So for the right amount of your portfolio, you're taking big risk, but the potential upside is much bigger than the risk that we're actually taking. How do we see this playing out? The first theme is the Ethereum versus Bitcoin flippening, where we see Ethereum outperforming Bitcoin over the next 5 to 7 year cycle. The second one is the DeFi renaissance, where we see the rise of DeFi as opposed to centralized finance. So that means you're not working on stock exchanges and banks, which are bricks and mortar. They're actually programs that exist in a Web3 situation, and central bank digital currency infrastructure, which means, as we used to have paper money, then we moved on to, banking apps and that, but we actually moved to the next evolution of money, which is actually cryptocurrency based rands and dollars and euros, which are central bank digital currency. So where do we see ourselves in the crypto market cycle? I'm looking particularly at Bitcoin here as a lead indicator. We use the halvening cycle, which determines at what rate miners are rewarded for the Bitcoin that they mine, or transactions that they mine. And the next halvening is forecast to occur around April 2024. And every single cycle, every halving cycle, the same pattern has played out. And history doesn't repeat, but it rhymes. And in the 18 months before the halvening, this is when you find the best entry points into particularly Bitcoin. And in the 18 to 24 months after that is when you see the best exit position. So we're actually teeing up right now for one of the best entry points to Bitcoin. And what we're saying is Ethereum is going to outperform Bitcoin. So we think, it will be a great entry point over the next few months into, if in our investment portfolios, when our clients give us money, 50% of the money is allocated into crypto and 50% is held in cash. And what we do is we'll be buying into those dips as we go. I'll skip this slide. Here we're just talking about Ethereum and why it's better or likely to outperform Bitcoin. It's because Ethereum is actually the paper on which the smart contracts are going to be run. And if Bitcoin is digital gold, Ethereum is digital oil. You need Ethereum for this for Web3 to actually function effectively. On the decentralized finance stage, we saw the failure of something like FTX. Now we're seeing the failures of banks. People will realize, or people may start to realize more and more, that they don't want to trust a single counterparty to be the trusted intermediary. They would rather actually transact without intermediaries. And that is already possible. There's decentralized exchanges which exist like Uniswap. There's DeFi lending like Aave. And derivative trading platforms like GMX, Synthetics, DopeX. So the digital currencies, you're aware about this, but what happens is when you swap digital currencies, if you're in South Africa and you're trying to buy rands into euros, some banks won't be able to do that for you on a US public holiday. It doesn't have anything to do with South Africa or Europe, but on George Washington Day, try to change rands into euros. And what will happen is most banks will tell you that you have to go through dollars to get to euros, and you can't do that because the US bank correspondent bank is closed, or we have those kinds of issues. So with central bank digital currencies, when you're swapping between digital rands to digital euros, those swaps will be transacted to Ripple or Quant, and we see those also being interesting cryptocurrency plays for the next period. When we look at our digital asset theme and the investing in our digital asset index, we also look at cryptocurrency-based firms. What happens with these firms is that they benefit from Bitcoin going up, but they also benefit from their PE ratios going up as sentiment improves. Zain, how are we on time?
We almost time for Isha.
Okay.
Would like to
see 3 more slides.
Okay.
Cool. So the crypto theme based on our analysis of historic performance, over a 5-year period, it still looks like it would deliver 533% in the sectors that we're looking at. In summary, we discussed high inflation, supply chain disruptions, Russia and Ukraine. We're moving towards very unpredictable times. and you need to position yourself right in the chaos. The 4 investment opportunities and themes that we mentioned that we like are defense, luxury, low volatility, and digital assets. That's our details there.
Thanks, Bilal. Quickly, we'll try and get through some quick questions if you don't mind. I'm going to first ask you to take out your crystal ball and tell me 2 things. Number 1 was you mentioned the period of heightened volatility. How long do you predict this to last?
18 to 24 months.
Sure, that long, huh? And
yeah.
Was Bitcoin 2 years ago, exactly 2 years ago, was sitting at $61,000. When do you see, or do you ever see it getting back to that level?
Definitely. I see Bitcoin being through $100,000 in the next 5 years, easily.
5 years, huh? All right, we have a question from Yusuf. How do we access all of these investment themes you're speaking about, and what products are available? If you can, I don't take you to cover, but if you can just briefly.
Okay. I didn't plan the question, but I do have my slides here. All right. So we have okay. So you can obviously this is an informative presentation. You can do it on your own. You can buy those themes with whichever investment manager that you currently use. You know, you can trade on IG markets, interactive brokers. You know, we use Swiss banks. We use Swiss Code Bank. Swiss banks are one of the most secure in the world. Yeah, so there are many ways to get access to these teams, and you can do with who you already work with. In our world, we have a portfolio where we actually have access to all of these teams. How it works is we have a minimum investment of $20,000, and what that does is it gives you $5,000 in each of these themes that we mentioned today, and that is with a Swiss-based bank that custodizes the situation. So you will have you need to externalize your funds from South Africa into dollars, and then receive the dollars offshore, and then that's how we make these investments. And so we have our Spectrum fund. That's our digital asset fund. Our digital asset fund is actually one of the top performing in the world. You can see here the blue line, and yeah, we've got our Zenith, Arbitrage, and yeah, I mean, yeah. So we can give you access to many of these themes if you're interested.
Maybe just put those your contact details up again for the guys. Any other questions we have from the participants? If anyone wants to ask any questions, please feel free to unmute yourself. Oh. Nothing. Okay, thanks, Bilal. On behalf of Minara Chamber of Commerce, we'd like to say a big thank you to you for taking your time out. I know it takes a long time to prepare a presentation like this. Just to be an hour here to speak to us. I'm sure you probably spent at least 10 hours on this. But yeah, thanks a lot. I've got Nazreen who's got a hand up there. Nazreen, do you wanna?
It's a high five.
Was that a high five?
It's totally a high five. That was an excellent presentation. Jazakallah for that, Bilal. Also, the question quickly is, because we want to wrap up, I know, is blockchain, do you think that we're seeing enough use in mainstream corporate environments, specifically the supply chain? And I think more I'm speaking from the just tracking on the halal supply chain side. Or is it an opportunity for younger businesses, especially on the African continent, to get on board more aggressively? Thanks.
Jazakallah. That's really a brilliant question. Yes, when we look at technology, we must ask ourselves a question: what problem does this technology solve? Right? If the technology solves a problem which is actually needs to be solved, then it's a good technology. Now, with halal certification or with blood diamonds, showing diamonds are clean, or authenticity of leather, or many supply chains where you need authenticity of where a product originated and who touched it, and whether it has gone through a proper process. The blockchain does offer immense benefit in terms of having a transparent record of that supply chain process. So I would say, yes, it is valuable and it could be used a lot more in terms of halal certification and in terms of other verifications of certification that are used, in many industries. The one caveat to that is that with blockchain, somebody needs to input that information into the system. And if you get garbage in, garbage out, right? So what we need to fix to ensure that the halal, blockchain process is 100% correct is that we need an audit, or a way to confirm that the information being put into that blockchain is actually correct. But that's a risk we currently live with anyway in any halal certification. We're trusting the people that say that they're following those particular rules. So all we would do then is we would have a blockchain version of that. But what I'm saying is, don't assume because the blockchain says that it's there now, a lot of process. You still have a human being somewhere saying, I've done things in the proper way, and somebody needs to check that actually happened.
All right, thanks, Bilal. Nazreen she agrees with you, and Jazakallah for the great feedback. So once again, on behalf of the Chamber of Commerce, thanks a million for your time. Appreciate it. Thanks to all the listeners and the participants that joined us on Zoom, on Facebook, on Instagram. We appreciate your time as well. Assalamu alaikum from Minara Chamber of Commerce. I'm Zain Mita.